Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report that's a bit like finding out your bank made a mistake, and it's a big one. We're looking at DriveItAway Holdings, and it seems they've had to admit some past financial statements weren't quite right. Buckle up because we're about to decode what that really means. Scroll item 4.02, non-reliance on previously issued. Financial statement/scroll. So what's the headline here? DriveItAway Holdings, which is a company involved in car-related ventures, had to say, oops, our numbers from earlier this year, specifically the 3 and 9 months ended June 30, 2024, can't be trusted anymore. That's never a good thing. When a company says you can't rely on their past financial reports, it's like saying the foundation of their financial house might be shaky. Scroll errors discovered for the non-reliance. Period relate to the non-reliance period's convertible notes/scroll. Why the change of heart? Well, it sounds like there were errors with how they handled something called convertible notes payable and related derivative liabilities. These are fancy terms, but essentially it involves debt that can turn into stock and some complicated stuff related to those types of investments. The company is working on fixing these errors, but it's significant enough that they're telling everyone to disregard those earlier reports. Scroll the errors in accounting in the company's financial statements for the non-reliance period included in the applicable quarterly reports/scroll. They're planning to fix these mistakes by restating their financial information. That means they're going back to those quarterly reports filed with the Securities and Exchange Commission, or SEC, and issuing corrected versions. It's like redoing your homework after realizing you got some major answers wrong. Because of these mistakes, you shouldn't rely on any news releases, investor presentations, or anything else that talked about the company's financials during that time. Scroll Management has assessed the effect of the restatement on the company's internal control over financial reporting/scroll. Now, this isn't just about fixing numbers. The company also looked at what this means for their internal controls. Internal controls are the processes a company has in place to make sure their financial reporting is accurate. And unfortunately, they found a material weakness. A material weakness basically means there's a significant problem in how they keep track of their money, so there's a real risk that mistakes could slip through again in the future. Scroll A material weakness is a deficiency, or a combination of deficiencies, in internal control over financial reporting/scroll. Let's break that down even further. A material weakness is a problem, or several problems, in how the company controls its financial reporting. It's so serious that there's a reasonable chance a big mistake in their financial statements won't be caught in time. Because of this weakness, the company admits that their controls weren't working well during that period of errors. Scroll the company's management has discussed the matters disclosed in this. Item 4.02 with Victor Mokualu, CPA PLLC/scroll. DriveItAway's management has been talking with their independent accounting firm about all this. That's a good sign because it means they're getting outside expert advice on how to fix the problems. Victor Mokualu, CPA PLLC, is the company's accounting firm since September 2024. The report is signed by John Passumato, the chief executive officer. That means he's taking responsibility for the information in the report. So what does this all mean for DriveItAway Holdings? Well, it's a bit of a mixed bag. On one hand, it's not great that they had to restate their financials and admit to a material weakness. It raises questions about how well they were managing their finances in the first place. On the other hand, they're being transparent about the issues, working to correct them, and getting help from outside experts. That suggests they're taking the problems seriously and trying to get things back on track. Now, without specific financial numbers to dig into from this filing, it's tough to give a complete picture. However, the fact that they are correcting past financial statements suggests that the situation is not ideal. Now, let's put on our decoder hats and give our overall take. In terms of direction, DriveItAway Holdings faces some headwinds. Restating financials and admitting to weak internal controls shakes investor confidence. However, their proactive approach to fixing these issues signals a commitment to improving their financial reporting. Risks: definitely the risk of further financial misstatements if they don't fix those internal control problems. Also, the company will need to work hard to regain the trust of investors and the public. Opportunities: if they can successfully restate their financials, strengthen their internal controls, and clearly communicate these improvements to investors, they have a chance to turn things around. A clean bill of health, financially speaking, could open doors for new investments and partnerships. Overall, DriveItAway Holdings is in a situation that requires careful attention. They need to focus on getting their financials right, fixing their internal controls, and regaining the trust of the market. That's all for today's Corporate Decoder. Thanks for watching. If you found this breakdown helpful, be sure to like, comment, and subscribe for more insights into the world of corporate filings. See you next time.